Scott Moe says that there needs to be increased cooperation with China. A news release that you guys had issued yesterday said that there needs to be a better working relationship on trade with China. That's specifically what the premiers were calling on the Prime Minister to do. So help me reconcile those two things. Is China the enemy, or do we work with China?
Premier Doug Ford didn't hold back. In the middle of one of the most uncertain trade climates in North American history, Ontario's premier stood before reporters and said the quiet part out loud: if Trump's tariffs continue, Canada may look east to China. This wasn't just a warning, it was a signal, a shift. One of Canada's most powerful provincial leaders openly floated the idea of deepening trade with Beijing, not Washington. And for the US, that could mean more than just a lost customer. It could mean a long-term strategic blow. So what happens if Canada actually pivots to China? Let's break it down. Since returning to the White House, President Trump has made tariffs the centerpiece of his trade agenda once again. His administration argues this is about fairness, making sure America isn't taken advantage of. But for Canada, these policies haven't brought clarity. They've brought volatility. Steel, aluminum, autos, and even softwood lumber have been hit. And now, a sweeping 35% tariff looms over all non-compliant Canadian goods starting August 1st. For business leaders across North America, this isn't a negotiation tactic. It's a threat that keeps shifting, and it's reshaping the foundation of what used to be the world's most stable trade partnership.
You know what Churchill said, our enemy of our enemy is our friend, and as long as China plays fair and doesn't undercut our markets, be it the auto sector or any sector, I have no problem dealing with them.
In response, Canada hasn't shouted, it's acted. Ottawa has quietly escalated its own tariffs on American steel and aluminum, matching the US increases. But more importantly, Canada is shifting focus. While there's still strong trade with the US, provincial leaders are building escape routes, pipelines, new export lanes, and diversified partnerships. That includes China. Ontario alone conducts over $43 billion in two-way trade with China, according to provincial figures. Imports dominate that number, but Ford is clear. If the US continues to act unpredictably, Canada will work with whoever plays fair, and that includes China. Even as Ford emphasizes protecting Canada's auto sector from Chinese EVs, his message is unmistakable. Canada is no longer beholden to the United States. We've already seen the signs. Canadian brewers are sourcing aluminum cans from China, not the US, due to skyrocketing prices from Trump's tariffs. RBC reports that as of June 2025, nearly 90% of Canadian exports entering the US are now fully USMCA compliant. A defensive move, proving Canadian businesses are adjusting supply chains to navigate around American uncertainty.
We buy about $349 billion of products. So Japan and the rest of the countries around the world have quite a bit to catch up to what we purchase off the US.
If Canada's pivot becomes permanent, the US will feel it in ways that go far beyond headlines. In 2024, Canada purchased $349 billion worth of American goods, more than Japan, Germany, and the UK combined. Losing even a portion of that trade to China would hit US manufacturers hard. Sectors like autos, machinery, agriculture, and energy rely on stable cross-border flows. If Canadian buyers shift orders to Chinese suppliers, the pain will be domestic, felt in states like Michigan, Ohio, and Pennsylvania. And it's not just about goods. Strategically, China has long sought to expand its influence in the Western Hemisphere. A deeper trade relationship with Canada would give Beijing more leverage in North America, something Washington has tried to avoid for decades. In trying to punish Canada, Trump may be pushing it into China's arms. Trump promised to win better trade deals. But tariffs have delivered something else: hesitation, retaliation, and uncertainty. Instead of pulling Canada closer, the White House is driving a wedge. A country that once stood as America's closest economic ally is now exploring other options, because it feels like it has to. Trump's tariffs were designed to protect American workers. But if those policies fracture trade relationships and push partners toward rival powers, then the damage may run far deeper than economic losses. In this new trade world, isolation isn't strength, it's a liability. And for the US, The question isn't whether tariffs backfire. It's how long we're willing to pretend they didn't.
Lula de Silva that Brazil will respond in kind with its own tariffs if the U.S. goes through what it wants to do by August 1. Your thought?
President Donald Trump's second-term trade doctrine has entered a volatile phase. In recent weeks, the administration has issued formal notices to a string of trade partners. 35% tariffs on Canada, 30% on Mexico, 50% on Brazil. These aren't just economic decisions. They are calculated power plays, and the world is responding. Rather than strengthening American leverage, Trump's tariff blitz is hardening resistance. Countries that once depended on U.S. trade are now coordinating responses, and in some cases, turning away altogether.
We both agree that it is essential to respect the USMCA trade agreements, and we shared our experiences about the letter we received from President Trump.
One of the clearest signs that Trump's pressure is backfiring came this week, when Canada and Mexico publicly pledged to strengthen bilateral trade. Both countries confirmed they had received tariff letters from the U.S., 35% for Canada, 30% for Mexico, set to take effect August 1st if negotiations fail. In response, Canadian Prime Minister Mark Carney and Mexican President Claudia Sheinbaum agreed to deepen economic cooperation. Carney is expected to visit Mexico in the coming weeks to formalize joint strategies. For two neighbors long tied to the U.S. through the USMCA, this pivot marks a significant realignment. Rather than fracture, Trump's tariff threats are pushing America's closest allies to close ranks, without the U.S.
Consider that maybe for the last 50 years, we are going through the worst moment in the relation between Brazil and Washington.
Tensions are even sharper further south. Brazil was hit with the steepest tariff, 50% on all exports to the U.S., up from 10% announced in April. Trump framed the move as retaliation for what he called political persecution of former Brazilian President Jair Bolsonaro, who faces charges for his role in the January 2023 coup attempt. Brazilian President Luiz Inácio Lula da Silva rejected the move as an act of political interference. His administration immediately activated a new fast response tariff mechanism, authorizing counter tariffs against U.S. goods. According to Brazil's Ministry of Development, only 12% of Brazilian exports are destined for the U.S., allowing the country to redirect trade with minimal disruption. The sectors affected include oil, orange juice, coffee, and steel. While the economic exposure is manageable, the diplomatic damage is real. Lula has publicly signaled a shift toward deeper ties with BRICS nations and Asian partners, a trend accelerated by Trump's moves.
This is unilateralism, and it's highly personalistic. It's President Trump because he doesn't like somebody. And, and I think it has very severe implications for U.S. relations with Latin America.
The ripple effects go beyond Brazil. In Colombia, relations have deteriorated rapidly after allegations emerged linking U.S. figures to an attempted political plot. Trump responded by recalling the U.S. ambassador and threatening to revoke Colombia's drug cooperation certification, a move that could cut vital aid. But instead of backing down, President Gustavo Petro has pushed back. His administration is now exploring deeper ties with BRICS institutions, including development financing outside the U.S. orbit. Across Latin America, a quiet realignment is underway. Countries are looking to diversify trade, reduce political exposure, and limit dependency on Washington. Trump's aggressive stance may be aimed at asserting dominance, but the region's reaction suggests it's having the opposite effect.
I mean, is it a political failure for the Prime Minister if Canada ends up with some level of tariffs at the end of this, or is it just the reality of dealing with Donald Trump?
What began as a strategy to strengthen U.S. leverage is now showing signs of unraveling. Rather than forcing deals on America's terms, the tariff campaign is driving partners together and away from Washington's orbit. Canada is no longer negotiating alone. Mexico is no longer avoiding alignment. Brazil, once neutral, is openly confronting U.S. influence. And in Europe, even close allies are preparing for long-term trade diversification. For the Trump administration, the short-term political optics may still resonate with parts of the domestic base. But the long-term cost is rising: fractured trust, declining diplomatic capital, and global supply chains that are learning to work around, not through, the United States. The real impact of these tariffs may not be in what they tax. It may be in what they break.
Mexican President Claudia Sheinbaum said on Wednesday that she and Canadian Prime Minister Mark Carney had agreed to strengthen trade collaboration.
And as countries seek other export markets, that's going to reduce the supply to U.S. markets.
The real cost of tariffs isn't just measured in dollars, it's trust, lost, and perhaps unrecoverable. Across global supply chains, confidence in the United States as a stable trade partner is wearing thin. Under President Trump's latest wave of tariffs, countries are no longer simply adjusting. They're rethinking their entire strategy. In Canada, that shift is especially visible. What began as a policy response to U.S. tariffs is now a national effort to reduce dependency on American goods, services, and even markets. Ottawa is strengthening trade ties with Europe, Mexico, and Asia. It's also prioritizing domestic production. The message is clear. If economic loyalty is punished, independence becomes a necessity. This erosion of trust is not just a diplomatic concern. It's reshaping where countries buy, sell, and invest for the long run.
And it is day 177 of the second Trump administration. And tonight, new inflation numbers are confirming what many economists have predicted, that Trump's tariffs would drive prices higher and higher.
For American consumers, the impact is now undeniable. According to the latest Consumer Price Index, inflation in June rose 2.7% year over year. Housing led the surge, but food, fuel, and durable goods also ticked up. Economists from Bank of America and Wells Fargo confirm what many feared. Tariff costs are filtering directly into retail prices. Yale Budget Lab projects that average U.S. import taxes could exceed 20% by August, an historic peak. Early year stockpiling delayed the pain, but that cushion is gone. As inventories run dry, companies are now restocking at tariff-inflated prices. That shift is beginning to show on the shelves.
As shoppers push their carts through the door, Urban Grocer is quietly pushing back, steering clear of anything grown in the U.S. Now that's been the case here for 117 days and counting.
Retail, that's a boycott.
North of the border, Canada's response is firm and deliberate. In British Columbia, a local grocer hasn't stocked U.S.-grown produce in over 117 days. What started as a modest cut quickly became a full phase-out. According to Nielsen IQ, American food product sales in Canada dropped 8.5% by volume in just a few months.
More Canadians come to America than tourists from any other country. Last year, Canadians made over 20 million visits to the U.S. and spent more than $20 billion here. But this year, many are not coming to America.
Tourism tells the same story. In June, car crossings from Canada into the U.S. fell 33%, the sixth month in a row of decline. In Vermont, resorts and breweries report a 30 to 50% drop in Canadian visitors. Some towns renamed streets and offered exchange rate discounts, but the absence is about more than pricing. To many Canadians, this is no longer a consumer choice. It's a political stance, driven by rhetoric they see as disrespectful and aggressive. Meanwhile, the U.S. market is feeling the deeper effects. As foreign suppliers redirect exports elsewhere, American buyers face fewer options and rising costs. Countries like Vietnam, Peru, Egypt, and South Africa are already filling Canada's supply gaps. Importers in the U.S. now face higher logistics costs, increased paperwork, and volatile pricing. And with more goods subject to tariffs, the ripple effects are spreading through manufacturing and retail. This isn't just a foreign tax anymore. It's becoming a domestic burden. President Trump points to rising tariff revenues, $64 billion in Q2 alone, as proof of success. But these gains come with growing inflation, trade distortions, and a widening credibility gap. Canada, led by Prime Minister Mark Carney, is emerging as a quiet but determined counterforce. Rather than respond with threats, Canada is playing a longer game, diversifying trade, reshaping supply chains, and building internal resilience. And that's where this all leads. The tariffs may raise revenue in the short term, But in the long term, they may cost the US the one thing that made it a global trade leader: reliability. Because once allies start walking away, it's hard to bring them back.